What if one of the most respected macro investors alive just stepped into the biggest money debate of this era and revealed that he may still be fighting the last financial war instead of the next one? Because that is what happened. A billionaire hedge fund legend went on a major podcast, laid out why Bitcoin still does not deserve to stand next to gold, and within hours, some of the sharpest people in digital assets came back with one brutal message. You are seeing the risk, but missing the transition. And that is why this matters so much. This is not just another internet argument about crypto versus gold. This is a collision between two completely different definitions of trust, two completely different visions of what money should be, and two completely different maps of where the financial system is heading next. So stay with me, because by the end of this video, you are not just going to hear both sides. You are going to understand why this debate could end up defining the future of money itself. Let's get straight into it. The investor at the center of this debate is not some random critic throwing out lazy anti-Bitcoin talking points. This is a man who built one of the most powerful hedge funds on earth, spent decades studying debt cycles, reserve currencies, collapsing empires, rising empires, and the mechanics of how monetary systems actually work. That is why his comments landed so hard. Because when someone with that kind of track record says Bitcoin still falls short of gold, people listen. But here is where it gets interesting. He did not come out and say Bitcoin is worthless. He did not say it is a scam. He did not say it has no place in a portfolio. In fact, he has openly acknowledged owning some Bitcoin himself. So this was not a total rejection. It was something much more important than that. It was a warning. A warning that Bitcoin, despite all the excitement around it, still does not meet the standard required to stand beside gold as a true store of value. And the way he built that case came down to three major points. The first was institutional legitimacy. His argument was simple. Gold has something Bitcoin still does not have, and that is deep trust from the institutions that run the global monetary system. Central banks hold gold. The United States holds gold. Europe holds gold. China holds gold. Nations that disagree on almost everything still agree on one thing. Gold belongs on the balance sheet. That matters, because central banks are not chasing narratives. They are not trying to catch the next trend. They are protecting national reserves. They are thinking in decades, not in cycles. And when those institutions continue to choose gold over Bitcoin, that tells him something very important. It tells him gold is still the asset the system trusts when the stakes are highest. And in his view, that trust is not a cosmetic advantage. It is the foundation. Because for something to function as real reserve money, it is not enough for retail investors to like it. It is not enough for online communities to defend it. It has to be accepted by the serious institutions that operate at the highest level of global finance. That is where he says Bitcoin still comes up short. The second criticism was even more interesting, because it flips one of Bitcoin's proudest selling points into a weakness. Bitcoin supporters love talking about transparency. Every transaction is recorded. The ledger is open. Anyone can inspect the chain. No one can secretly alter the monetary history of the asset. That is one of the reasons people call it trustless money. But his response was sharp. He said transparency is not automatically freedom. Sometimes transparency is exposure. Because if every transaction is permanently recorded on a public ledger, then activity can be watched, mapped, analyzed, tracked, and potentially controlled. Wallets can be studied. Flows can be traced. Governments with enough resources can monitor far more than most users like to imagine. And from that angle, Bitcoin's openness does not look like perfect liberation. It looks like a surveillance surface. Gold, by contrast, is physical. You can hold it, move it, store it privately. It does not require a network. It does not depend on software. It does not leave a digital history every time it changes hands. That difference matters more than people think. Because if the future becomes more hostile, more regulated, more aggressive, and more surveillance-driven, then public traceability may become a burden rather than a feature. And then came the third criticism, the one that grabbed the most attention: quantum computing. This is where the debate turns from macro philosophy into technical threat. Bitcoin's security depends on cryptography. The private key protects the asset. The mathematics behind the system make it effectively impossible for current computers to reverse engineer ownership from public information. That is why the network is secure today. But the concern is about tomorrow. If quantum computing eventually reaches a level where it can break the cryptographic assumptions behind current wallets, then the core security model of Bitcoin could face a genuine threat. Not tomorrow. Not next week. Maybe not for many years. But still, the possibility exists. And if an asset's entire model depends on digital security, then any future technology that can challenge that security becomes a serious issue. In his framework, that risk cannot be casually brushed away. It has to be taken seriously. So when you strip it all down, his case is actually pretty disciplined. Bitcoin does not have central bank endorsement. Its public ledger may make it more vulnerable to monitoring than people admit, and its long-term security depends on cryptographic assumptions that future computing power might challenge. That is the case. And if all you saw were headlines, you might think that sounds devastating for Bitcoin. But this is where the story really starts. Because the pushback did not come from random anonymous accounts screaming on social media. It came from serious people, institutional people, research people, people who spend all day studying digital assets, monetary evolution, protocol design, adoption trends, and where this whole thing may be heading. And their response was not, "Those concerns are fake." Their response was much smarter than that. They said the concerns are real, but the investor may be misunderstanding what those concerns actually mean for Bitcoin's value. One of the strongest counterarguments came from the idea of pricing, and this point is powerful. Bitcoin is still dramatically smaller than gold. Gold's market value towers over Bitcoin's. The gap is enormous. And the argument from the digital asset side is that this gap exists precisely because the risks are not ignored. They are already reflected. In other words, Bitcoin is not priced like gold because it is not yet gold-like in the eyes of the world. The uncertainty is the discount. That changes the whole conversation. Because if you believe those uncertainties will never be solved, then Bitcoin deserves to stay discounted. But if you believe those uncertainties will be reduced over time, if you believe the network will get stronger, regulation will become clearer, custody will mature, infrastructure will improve, and institutions will grow more comfortable with it, then the current gap is not proof of weakness. It is the opportunity. That is a very different lens. It says the criticism is not a reason to dismiss Bitcoin. It is the reason the upside still exists. And that is where the debate becomes much more sophisticated. Because suddenly this is not a simple fight between safe gold and risky Bitcoin. Now it becomes a question of transition. What if Bitcoin is not supposed to look fully finished yet? What if the things traditional investors see as evidence that it is unworthy are the very things growth investors see as evidence that it is still early? That is the split. Then the second major counterattack came at the idea that these criticisms are somehow new. On the crypto side, many argued that these are old narratives wearing fresh clothes. The claim is that Bitcoin has already lived through more tests than many people admit. It has survived brutal crashes. It has survived regulatory attacks. It has survived exchange collapses, media ridicule, elite dismissal, policy uncertainty, and multiple declarations of death. And after all of that, it is still here. Not only still here, bigger, stronger, and more institutional than before. That matters, because at some point, survival itself becomes part of the thesis. A fragile asset does not survive repeated global stress tests and keep coming back into the financial conversation at a higher level every cycle. A fad does not force major institutions to keep revisiting it. A joke does not keep rebuilding legitimacy after each collapse. And that is why the crypto side looks at these warnings and says, "We have heard versions of this before." The network kept moving. The infrastructure kept building. The user base kept expanding. The asset kept graduating into more serious rooms. That does not automatically prove Bitcoin wins, but it does weaken the idea that old criticism alone is enough to bury it. Then there is the quantum computing issue. This is where the response got even sharper. Because yes, the threat is real in theory, but the counterpoint is devastatingly simple. If quantum computing becomes powerful enough to break the cryptographic foundations of Bitcoin, then Bitcoin is not the only thing in trouble. Banks are in trouble. Governments are in trouble. Military communications are in trouble. The internet is in trouble. Modern digital civilization runs on encryption. So the question is not just whether Bitcoin will have to adapt. The question is whether the entire digital world will have to adapt. And the answer is obviously yes. That means Bitcoin is not facing some isolated doomsday scenario that applies only to it. It is facing the same future technical challenge that the broader digital system is facing. And according to many people in the technical community, that challenge is already being worked on. Post-quantum cryptography is not some fantasy topic. It is an active area of research. New standards are being developed, new protections are being studied. So the argument from Bitcoin defenders is not that quantum risk is imaginary. It is that the risk is known, shared, and likely addressable long before it becomes immediate. That is a huge distinction, because a known future challenge with an active global effort behind solving it is very different from an undiscovered flaw waiting silently in the dark. Then came one of the deepest arguments of all. And honestly, this may be the most important idea in the entire debate. Gold and Bitcoin are not just competing assets. They are answers from two different eras. Gold solved the trust problem in the physical world. It is scarce. It is durable. It cannot be printed by a central bank. It can be tested, weighed, stored, and recognized across borders and generations. In the analog age, that made it extraordinary money. But Bitcoin is trying to solve the trust problem in the digital world. That is a different battlefield. In a world of databases, online payment rails, sovereign debt explosions, digital surveillance, global internet connectivity, and money moving at the speed of code, physical scarcity is no longer the only form of trust. Now mathematical scarcity matters. Open verification matters. Network neutrality matters. Portability matters. Settlement without permission matters. And that is where Bitcoin supporters say traditional frameworks can fall behind reality. Because if you evaluate a digital monetary network only through the logic of physical reserve assets, you may correctly identify what it lacks, while completely missing what it introduces. Gold cannot be teleported across the internet. Gold cannot settle globally in minutes. Gold cannot plug into digital systems the way software-native money can. Gold is incredible at being gold. But Bitcoin is not trying to be a better gold bar sitting in a vault. It is trying to become scarce digital money for a digital century. That is a totally different ambition. And once you understand that, the entire debate changes shape. Now, one of the most important battlegrounds in all of this is central bank adoption. Because that is where the old world still holds a major advantage. Gold is already inside the castle. Bitcoin is still outside, knocking on the gate. That is reality. But here is the question that makes this debate so explosive. Is that permanent? Or is it just a stage? Because institutional adoption does not happen all at once. It moves in layers. First, almost no one takes the asset seriously. Then early believers accumulate. Then specialists emerge. Then funds form around it. Then public companies begin experimenting. Then governments start talking about it. Then maybe smaller state actors move. Then perhaps one day larger institutions reconsider what belongs in reserve strategy. We have already seen multiple stages of that process play out with Bitcoin. And that does not guarantee the final stage arrives. It does not guarantee major central banks embrace it. It does not guarantee full reserve legitimacy. But it does matter that the line of movement so far has not been backward. It has been forward. Slowly, unevenly, volatile, messy, but forward. And that is why this debate matters far beyond one podcast clip. Because what you are really watching is not a simple gold versus Bitcoin argument. You are watching legacy monetary logic confront emerging monetary logic in real time. One side says trust is strongest when powerful institutions validate the asset. The other side says trust is strongest when no institution has the power to alter the asset. One side says history matters most. The other says architecture matters most. One side says reserve status is earned through centuries. The other says digital networks compress time and can build legitimacy faster than old systems expect. And maybe the most uncomfortable truth of all is this. Both sides have something real. Gold has history, institutional depth, and physical permanence. Bitcoin has portability, programmability, and digital native scarcity. Gold is old trust. Bitcoin is engineered trust. Gold speaks the language of empires. Bitcoin speaks the language of networks. So who wins? That is the wrong question. At least for now. Because the more honest question is this: what kind of world are we moving into? If the future remains dominated by central banks, sovereign reserve strategy, and physical hedging against system instability, gold keeps its crown. But if the future becomes increasingly digital, increasingly borderless, increasingly distrustful of institutions, increasingly online, and increasingly hungry for assets that can move as fast as information itself, then Bitcoin's case gets stronger with every passing year. That is why this battle feels so important. It is not really about a single billionaire being right or wrong. It is about whether the monetary assumptions that governed the last century are enough for the next one. And that is not a small question. That is the question. Because when people hear this debate, many of them instinctively try to reduce it to price. Which one goes higher? Which one is safer? Which one should I buy? But the deeper layer is much bigger than that. This is a debate about the source of financial credibility in the modern world. Does money require endorsement from the system? Or can money emerge from code, consensus, and network belief without asking the system for permission first? That is why this conversation keeps getting more serious. That is why the people involved keep getting more sophisticated. That is why this subject refuses to stay on the fringe. When some of the most experienced macro thinkers in the world are arguing directly against some of the most informed digital asset researchers in the world, this is no longer a niche conversation. This is a frontline argument about the architecture of global finance. And whether you love Bitcoin, hate Bitcoin, trust gold, distrust gold, or sit somewhere in the middle, you need to understand this moment, because it is shaping the language of money going forward. And here is my view. The most dangerous mistake in finance is not being wrong. It is being so anchored to an old framework that you fail to see when the world starts operating under a new one. That does not mean the old framework becomes useless. It means you have to know where it still works, and where it starts losing explanatory power. Maybe gold remains essential. Maybe Bitcoin keeps maturing. Maybe both survive because they solve different versions of the same human problem. But dismissing either side too casually now looks reckless, because gold is not obsolete, and Bitcoin is not irrelevant. Not anymore. This debate is too advanced for that. And that is exactly why you should be paying attention. Because once the conversation reaches this level, the people who still treat it like a joke are usually the ones who realize too late that the world already moved. So now I want to ask you something. When the next global monetary shock hits, the kind that forces everyone to rethink what they trust, which asset do you believe people run toward first? And bigger than that, what matters more in the future of money, institutional acceptance or unstoppable code? Drop your answer in the comments. I really want to see where you stand on that. And if you are getting value from this kind of breakdown, subscribe now and stay close, because the biggest money debates of this decade are only getting started. This is not fringe anymore. This is the future, arguing with the past in public. And the outcome could redefine money for everyone.